Welcome to the Deep Dive, the place where we take complex professional standards and, well, we break them down into what you really need to know. Whether you're gearing up for your audit and assurance exams, or maybe just starting out on your first engagement.
That's right.
Today, we're focusing on something absolutely fundamental. It's the bedrock for the success of pretty much any audit, the planning and risk assessment phase.
It really is. If you get this part wrong, everything that follows, well, it's going to be inefficient, definitely. And worst case, it could be totally ineffective in actually achieving what the audit is supposed to do.
It's like building a skyscraper, isn't it? You wouldn't just start throwing up walls.
Exactly. You need that solid foundation. Think of planning as, well, it's not just the foundation, it's the feasibility study, checking the ground conditions, the architectural blueprints, getting the permits.
Yeah.
It's all of that rolled into one. If the plan's flawed, the whole structure is compromised.
And for all of you studying hard right now, let me just emphasize this. Getting your head around planning and risk assessment. It's probably the single most vital skill for tackling those scenario-based exam questions. You really need to understand the why.
You do. It's not just about memorizing steps, it's about applying them to new situations, which is what those scenarios test.
So our mission today is to connect three areas that sometimes feel a bit separate but are actually one continuous flow. We're looking at, first, how an auditor actually gets the job, the appointment process. Second, the detailed work involved in setting everything up and, crucially, really understanding the client's business.
Yes, getting under the skin of the entity.
And third, that core concept of audit risk, that equation that kind of dictates everything else.
That's the one. It's all about identifying and assessing uncertainty.
So if you've ever felt a bit lost trying to connect those initial checks with, say, the final testing procedures, stick with us. We're aiming for those aha moments today.
Let's get into it.
Okay, let's kick things off right at the very beginning. A potential client knocks on the door, figuratively speaking. Before anyone even thinks about signing anything, what are the absolute must-do checks? What's this professional due diligence all about?
Right. This isn't just good practice. It's a professional duty. It protects the firm, protects its reputation, and ensures you're complying with all the ethical standards. We usually break it down into 3 essential hurdles you've got to clear before you can even think about drafting that engagement letter.
3 key checks. Let's take the first one. What's the absolute baseline?
Well, the first is legal and ethical qualification. Sounds obvious, maybe, but the firm must confirm it's legally allowed to act as auditor, and critically, that everyone involved, partners, staff, are independent.
So no conflicts of interest.
Precisely. The most immediate disqualifier is a lack of independence. For example, if a partner owns shares in the client company, or maybe their spouse is a director there, that's usually a non-starter. You can't audit your own work or have those close ties.
Okay, so independence is paramount. Let's say the firm is legally clear. What if the client's business is really complicated? Like super niche?
Ah, good point. That brings us straight to the second check. Assessing if you have adequate resources and the right expertise. It's not just about having people free.
You need the right people.
Exactly. The firm has to honestly ask itself, do we have the skills for this specific job? If it's a bank, do we understand, say, complex financial instruments or the specific regulations they face?
Or like a tech startup with weird revenue recognition?
Precisely. Or a pharmaceutical company with specific R&D accounting. If the firm doesn't have that specialist knowledge in-house or can't bring in an expert they trust, they really should decline. Taking on a job you're not competent to do. That's a direct threat to audit quality. It's just not on.
Competence is non-negotiable. Got it. Okay, check 1, legal and ethical. Check 2, resources and skills. What's the third piece? This one looks outwards, right?
Yes. The third one is a thorough client investigation. You're essentially doing a background check on the client's integrity. We look closely at management, the directors, anyone charged with governance.
What are you looking for? Red flags.
Definitely red flags. Things like a history of really aggressive accounting, maybe past run-ins with regulators, any whiff of fraudulent activity in the past. You have to ask yourself, is this management team trustworthy?
Because the reputational risk is massive if you get involved with someone dodgy.
It's huge. Honestly, the relatively modest fee you get for an audit is never worth the potential damage to your firm's reputation if that client blows up publicly. You have to vet them carefully.
Makes total sense. The auditor's signature is their currency. Now, still in this initial phase, let's talk fees. That can create some ethical headaches, can't it?
Oh, absolutely. Fees are a classic self-interest threat. We have to be really careful about a few specific scenarios here.
What?
Okay, first one. High percentage fees. Now, this mainly applies to public interest entities, PIEs, think large listed companies. If the total fees from that one PIE client creep over 15% of the audit firm's entire income.
15%.
Yes, 15% for 2 years running. That's a serious problem.
Why is that specific number such a danger zone?
It creates dependency, doesn't it? If losing that one client means a 15% revenue hit, subconsciously or not, the auditor might be less inclined to push back hard on difficult issues. Their skepticism could be compromised because they're worried about losing the client.
So you'd need safeguards or potentially have to resign.
Exactly. Safeguards must be put in place, or, yeah, you might have to walk away. Another big no-no is linking fees to the outcome.
Contingent fees.
Absolutely forbidden for audit. You can't have a fee based on, say, the level of profit reported or the share price. It completely destroys objectivity. The auditor would basically be incentivized to help boost the numbers. That's a massive conflict.
Clear conflict. Okay, what about just quoting a really low price to get the business? Lowballing.
Yeah. Lowballing is tricky. You quote a super low fee, maybe planning to make it up later with other services. While it happens in business, ethically, it raises a big question for the audit. Can they really do a proper, thorough job for that price?
It suggests corners might be cut, right?
It does. It implies that maybe the necessary time, the experienced staff, the resources, maybe they won't actually be dedicated if the firm is losing money on the audit itself. It casts doubt on quality right from the start.
Okay, so assuming we've navigated all those ethical checks, independence, resources, client integrity, fee issues, what's the next mandatory step? That crucial chat with the old auditors.
Yes, communicating with the existing auditor. This is absolutely non-negotiable. It's a professional requirement designed to protect the incoming auditor. There's a very strict process.
Walk us through it. Step 1.
Step 1. The new auditor, that's us, potentially must ask the potential client for their permission to contact the previous auditor. It's basic professional courtesy and a standard requirement.
Okay, straightforward enough. But what if the client says no, or they just drag their feet?
Then it's simple. Game over. You must decline the appointment.
Must decline. No wiggle room.
None. If a client refuses permission, that's a huge red flag. You have to ask, what are they trying to hide? It usually means there was a major disagreement, maybe about accounting treatment, or perhaps concerns about management's integrity that the previous auditor had. You just can't proceed if the client blocks that communication.
Right. Withholding permission speaks volumes. So let's say the client does give permission. What's next? Does the old auditor just spill the beans?
Not quite. Step 2 involves the previous auditor. They're bound by confidentiality, remember. So they must then ask the client for permission to actually share information with the new firm.
Hang on, so the client gives permission twice. Once for the new guys to ask, and again for the old guys to answer.
That's correct. It protects everyone involved. Assuming the previous auditor gets the okay, their response should be professional and stick to the facts relevant to the change.
So they shouldn't be complaining about fees or anything.
No, the purpose is purely professional. Finding out why the change is happening. Did the previous auditor resign over a serious concern? Were they removed because of a disagreement on accounting policy? Did management refuse to provide necessary information? That's the kind of crucial detail the new auditor needs.
It's all about understanding the risks you might be inheriting.
Precisely. You're gathering intelligence to make an informed decision about whether to accept the engagement. Declining if permission is withheld is mandatory. But even if permission is granted, you might still decline based on what you learn.
Okay, makes sense. So after all these checks, internal, external, ethical, communication, we finally decide, yes, we'll take this client on. How do we make it official? That's the engagement letter, right?
Yes, the engagement letter, governed by ASA 210. But before you even issue that letter, there are a couple of fundamental preconditions that absolutely must be in place.
Preconditions. Okay, what are they?
Yeah, 2 key things. First, the client has to be using an acceptable financial reporting framework. Think IFRS, or maybe a specific local GAAP. If they're just, making up their own accounting rules as they go along, you can't audit that. It needs to be a recognized, consistent framework.
Makes sense. You need rules to audit against. What's the second precondition? This one's about management.
Yes, and it's critical. Management must formally acknowledge and, crucially, understand their responsibilities. This isn't just paperwork. They need to get it.
And those responsibilities are?
3 core things. 1, they are responsible for preparing the financial statements. 2, they are responsible for designing, implementing, and maintaining internal controls to enable that preparation. And 3, they must provide the auditor with unrestricted access to everything, all records, all information, all the people we need to talk to.
So if management thinks internal controls are the auditor's job,
Then the preconditions aren't met, and you cannot accept the engagement. The roles have to be crystal clear from the outset.
right. So assuming those preconditions are met, we issue the engagement letter. Why is this document, which can seem a bit dry, actually so important?
Oh, it's incredibly important. It's the legal contract between the auditor and the client. It defines the scope, the objectives, and crucially, the responsibilities of both sides. It's your main defense if things go wrong later.
How so? What key things does it establish?
Well, two things are vital. First, it clearly states that an audit involves testing and sampling and therefore provides reasonable assurance, not absolute assurance. It manages expectations. It says, we'll do a thorough job based on risk, but we're not guaranteeing there is zero errors or zero fraud. This helps protect against the expectation gap.
The idea that the public sometimes thinks an audit is a 100% guarantee.
Exactly. The letter clarifies it isn't. Second, it explicitly confirms the auditor's expectation of unrestricted access. If, down the line, management tries to block access to, say, records for a foreign subsidiary,
Scope limitation.
precisely, the engagement letter gives you the contractual basis to say, look, you agreed to unrestricted access. If you deny it, we may have to modify our opinion or even withdraw. It provides the legal teeth for the auditor to do their job properly.
So that whole appointment process is far from just a formality. It's rigorous, layered, and absolutely critical for setting the stage correctly.
It really is. It's probably the phase where the audit firm itself carries the most immediate risk if they get it wrong.
Okay, the engagement letter is signed, sealed, delivered. The firm has decided to take on the audit. Now, the focus shifts, doesn't it, from should we do this to, okay, how do we do this efficiently and effectively? How does the team move from acceptance to actually building a concrete audit plan?
Right, now we're firmly into the planning stage proper. And this flows directly into risk assessment, which then dictates our response. So planning leads to understanding, which leads to risk assessment, which then informs the response. It's a logical sequence.
And the goal of all this planning effort, why invest so much time up front?
It's all about making the audit effective and efficient. There are several key objectives here. First, we need to make sure we focus our attention on the important areas.
The high-risk bits.
Exactly. Where is material misstatement most likely? Is it complex revenue recognition? Is it inventory valuation? Is it potential going concern issues? Planning helps us allocate resources there, not get bogged down in trivial stuff.
Okay, focus on important areas.
Second, identify potential problems early on. Maybe the client just implemented a brand new, complex IT system.
Uh-oh.
Right. Or maybe there's been huge turnover in their finance team and the new staff are inexperienced. Or perhaps they've expanded into a really volatile overseas market. Spotting these risks early means we can plan for them, maybe assign more senior staff or plan specific procedures.
Proactive problem spotting. Makes sense.
Third, planning ensures the audit is performed expeditiously, that's efficiently, without unnecessary delays. This involves putting the right team members with the right skills onto the right parts of the audit.
Matching skills to tasks.
And finally, it helps us coordinate the work effectively. Are we relying on the client's internal audit function for anything? Do we need to bring in an IT specialist or evaluation expert? Planning allows us to schedule and manage that coordination.
So it's about being targeted, proactive, efficient, and coordinated. Now, to manage all this, auditors use specific documents. We hear about the overall audit strategy and the audit plan. Are they the same thing? What's the difference?
Good question. They're related but distinct. The overall audit strategy is the high-level game plan. It sets the scope, timing, and direction for the entire audit.
Like the big picture view.
Exactly. It's where we make the big decisions. What's the overall materiality level going to be? How much reliance, if any, do we plan to place on internal controls? Do we need specialist skills? When will the key phases, like interim and final audit work, happen? It sets the strategic direction.
Okay, so strategy is the what and why at a high level. What about the audit plan?
The audit plan is much more detailed. It's the how.
Yeah.
It describes the specific nature, timing, and extent of the audit procedures we're going to perform. This includes the initial risk assessment procedures we'll use, and then the detailed tests, the substantive procedures we plan to carry out in response to those assessed risks.
So the plan is the detailed instruction manual for the audit team in the field.
That's a good way to put it. And crucially, both the strategy and the plan aren't set in stone. They have to be reviewed and updated throughout the audit. Why? Because what we find during our initial work might change our assessment of the risks.
Things rarely go exactly to plan, I suppose.
Almost never. You might find controls are weaker than you thought or discover a new risk area, so the plan has to be dynamic.
Now, to even start drafting that strategy or plan, the auditor needs to properly understand the client. What does understanding the entity and its environment actually involve? What key areas do we need to dig into?
This is absolutely mandatory under the standards. You have to do this to identify and assess the risks of material misstatement, the ROMM. We typically look at about 5 key areas.
Okay, what's number one?
First, the industry, regulatory, and other external factors. Is the client in banking or insurance facing heavy regulation? Are there new environmental laws impacting them? What's the general economic climate like for their sector?
So the outside world affecting the client.
Yes. Second, the nature of the entity itself. How does it operate? What's its ownership structure? Is it family-owned, private equity-backed, listed? How complex is its structure? How is it financed lots of debt? We need to understand its core business model, its products, markets, suppliers, the whole ecosystem.
Getting a feel for the business itself. Third,
The entity's objectives and strategies, and the related business risks. What is management trying to achieve? Are they aiming for rapid growth, launching new products, expanding internationally? Aggressive strategies often lead to increased risks, including the risk of management trying to bend the accounting rules.
strategy links to risk. Got it. Fourth area.
Fourth is how the entity measures and reviews its financial performance. How does management monitor results? Are there key performance indicators, KPIs they focus on? Crucially, how are executives compensated?
The bonus culture.
Exactly. If bonuses are tightly linked to hitting, say, a specific profit target, the pressure on management to manipulate earnings, perhaps through aggressive accruals or optimistic estimates, goes way up. That's a direct link to potential misstatement risk. You always need to ask how they measure success and how people are incentivized.
Definitely one to watch out for in exam scenarios.
Good.
Okay, and the fifth area.
Fifth is the entity's selection and application of accounting policies. Are the policies they use appropriate for their business and compliant with the relevant framework, like IFRS? Are they consistent with industry practice? Are they applied consistently year on year? Any changes in accounting policy need careful scrutiny.
Okay, so understanding the industry, the business itself, its goals, how it measures success, and its accounting rules. That's quite comprehensive. How does the auditor actually get all this information, especially early on? What are these initial risk assessment procedures?
Right. These are the procedures we use specifically to gather that understanding and identify the potential row. There are 3 main types we rely on heavily at this stage.
What's the first?
First is inquiries. Simply put, we talk to people.
Who do you talk to?
Management, definitely.
Huh.
But also the finance team, internal auditors if they exist, maybe the sales team to understand revenue drivers, possibly in-house legal counsel about any litigation. We're asking open-ended questions, trying to uncover known issues, areas of judgment, potential weaknesses, or recent changes.
So asking the right questions. Second procedure.
Second is observation and inspection. We don't just rely on what people tell us. We look for ourselves. This could involve observing processes like watching how they handle inventory receipts or dispatch goods.
Seeing in action.
Yes. And inspection involves reading documents. We'll look at things like prior year financial statements and audit files, business plans, board minutes, significant contracts, internal control manuals, organizational charts. It's about gathering corroborating evidence.
Okay, inquiries and observation inspection. And the third one you mentioned sounds like a powerful tool.
Ah, yes, analytical procedures. This is often the auditor's first line of defense in spotting potential problems. It's mandatory during planning and also at the final review stage.
What exactly are analytical procedures?
They involve evaluating financial information by studying plausible relationships among both financial and non-financial data. Basically, you're looking for anomalies, for things that don't make sense.
How do you do that? Comparisons.
Exactly. You compare the current year's figures to prior years, to budgets and forecasts, maybe even to industry averages or competitor data. You calculate key ratios like gross profit margin, receivables days, inventory turnover, and see if they've changed significantly or unexpectedly.
Give us a really clear example of how this works in practice.
Okay, let's stick with inventory. Imagine the client's inventory turnover days last year were, say, 34 days. Pretty typical for their industry. This year, you calculate it based on the draft figures, and it suddenly jumped to 97 days.
Wow, nearly 3 times as long to sell their stock.
Precisely. That's a huge jump. It's not plausible unless something dramatic has happened, like a major change in product line or a collapse in demand. That massive change immediately signals a high risk related to inventory.
What specific risk?
Primarily the valuation assertion. Is that slow-moving inventory actually worth what it's stated at on the balance sheet? Is it obsolete? Does it need to be written down? That analytical procedure has just pinpointed a major risk area requiring significant audit attention. Without it, you might have missed it or spent too much time on less risky areas.
It focuses the audit effort immediately. That's powerful. Now, thinking about the timeline again, we often hear about an interim audit happening sometime before the year end. Why do auditors do that? What's the purpose?
The interim audit is largely about efficiency. It usually happens a few months before the year end. Its main purpose is typically to document the client's systems and test their internal controls.
Testing controls before the year end.
Yes. We want to find out early if the controls the client says they have are actually working effectively in practice. If we test them at the interim stage and find they are effective.
Then you can rely on them.
Potentially, yes. It means we might be able to reduce the amount of detailed substantive testing we need to do on the actual account balances later at the final audit. This saves time during the busiest period after year end.
And if the controls aren't working when tested at interim,
Then we know early on that we can't rely on them and we'll have to plan for much more extensive substantive testing at the year end. Finding this out in, say, October is much better than finding it out in February when you're up against reporting deadlines.
so the planning stage is really about mapping out the battlefield, understanding the terrain, the client's business, identifying the likely enemy positions, the risks, and then deciding on the strategy and tactics, the audit approach and procedures. It's all interconnected.
Perfectly put. And that leads us directly into the core concept that underpins all of this. Audit risk.
Right, we've planned, we've understood the entity, we've used procedures like analytics to sniff out potential risk areas. Now we need the framework to really think about that risk. Let's talk about audit risk. What exactly is it in simple terms?
Audit risk is the risk that the auditor expresses the wrong opinion.
The wrong opinion, you mean?
I mean, giving a clean or unmodified opinion, saying the financial statements give a true and fair view when, in actual fact, they contain a material misstatement. It's the risk of getting it wrong, essentially.
And you always hear that audit risk can never be zero. Why is that? Why can't auditors guarantee finding every single error?
Because of what we call the inherent limitations of an audit. There are fundamental reasons why absolute assurance is impossible.
Okay, what are these limitations?
Well, first, there's the nature of financial reporting itself. Many items in the financial statements involve judgment and estimation. Think about provisions for warranty claims, or the useful life of an asset for depreciation, or valuing complex financial instruments. Judgment implies uncertainty. It's not black and white.
So, estimates are inherently risky. What else?
Second, the nature of audit procedures. We have to perform the audit within a reasonable time frame and at a reasonable cost. This means we rely heavily on sampling. We can't check every single transaction. Imagine auditing a supermarket's sales.
It would take years and cost a fortune.
Exactly. So sampling introduces the risk that our sample isn't perfectly representative of the whole population. We might miss errors just by chance.
Okay, judgment and sampling. Is there a third key limitation?
Yes, and it's often the trickiest one. The possibility of fraud, particularly fraud involving collusion or deliberate concealment by management. If management is determined to mislead the auditors, perhaps by overwriting controls or providing falsified documents, it can be incredibly difficult to detect. Audits are designed to detect material misstatement, whether due to error or fraud, but cleverly concealed fraud is inherently harder to find.
So because of judgment, sampling, and the possibility of hidden fraud, we can only ever provide reasonable assurance, not absolute.
That's the core idea. Reasonable assurance is a high level of assurance, but it's not a guarantee.
Now, this concept is often summarized in the audit risk model. Can you remind us of the equation?
Sure. It's usually expressed as ARX, CRX, DR. Audit risk equals inherent risk multiplied by control risk multiplied by detection risk.
AR, IRX, CRX, TR. Now, you often hear warnings about treating this too mathematically. Why is it more conceptual?
Because we're not typically plugging precise numbers or percentages into this formula in practice, it's more about understanding the relationship between the components. The model shows that audit risk, AR, is a product of the client's risks, that's inherent risk, IR, and control risk, CR, and the auditor's own risk detection risk, DR.
And the auditor wants to keep overall audit risk, AR, low, right, to avoid giving that wrong opinion.
Exactly. The auditor sets a target for an acceptably low level of AR. The model then tells us how the other risks interact. If our assessment shows that the client's risks, IR and CR, are high,
Meaning the client's business is inherently risky and their controls are weak.
then to achieve that target low AR, the only factor the auditor can influence, detection risk, DR, must be set at a very low level.
And setting DR low means?
It means doing more audit work, more procedures, more rigorous testing, gathering higher quality evidence. There's an inverse relationship. The higher the client's risk, IR x CR, the lower the auditor needs to drive their detection risk, DR, which means more effort from the audit team.
Okay, that relationship is key. Let's break down those components. Start with inherent risk, IR. What is that again?
Inherent risk is the susceptibility of an account balance or class of transactions to a material misstatement, assuming there were no related internal controls. It's the raw riskiness of the item itself or the environment.
What kind of things make IR higher? Give us some examples.
Okay, complexity is a big one. Highly complex transactions like derivative accounting or intricate revenue streams have higher IR. Subjectivity. Items involving significant estimation like impairment calculations or development cost capitalization have higher IR than things based on simple facts, like the cash balance.
So judgment increases IR.
Definitely. Also, the nature of the business. A business dealing mainly in cash has higher IR for theft than one dealing only in electronic transfers. An industry facing rapid technological change might have higher IR for inventory obsolescence and external pressure. If management is under pressure to meet targets, maybe due to debt covenants or upcoming IPO plans, the IR related to potential management bias increases.
So IR is about the fundamental riskiness before controls even come into play. What about control risk, CR, then?
Control risk is the risk that a misstatement that could occur in an account balance or transaction class will not be prevented or detected and corrected on a timely basis by the client's internal control system. It's about how effective the client's own checks and balances are.
And what makes CR high or low?
It really depends on the quality of the client's whole control environment. Is there a strong tone at the top from management emphasizing controls? Are the control procedures themselves well designed for the risks they're meant to address? And crucially, are they actually operating consistently? You can have the best design control on paper, but if staff ignore it or management overrides it, then CR is high.
So it's about design and operation.
Yes. You need both for CR to be assessed as low.
Okay, so if we combine those two, IR and CR, we get the risk of material misstatement. ROM, right? That's the risk the client's financials contain a material error before the auditor even starts their detailed testing.
Exactly. ROM equals IR x CR. That represents the riskiness flowing from the client.
Which brings us back to the auditor's part. Detection risk, DR.
Yes. Detection risk is the risk that the procedures performed by the auditor to reduce audit risk to an acceptably low level will fail to detect a misstatement that exists, and that could be material, either individually or when aggregated with other misstatements. It's the risk that our work doesn't catch the error.
And this is the only part the auditor directly controls.
That's right. We assess IR and CR based on our understanding and testing of the client, but we set the level of DR based on how much risk we're willing to accept that our own procedures might miss something.
So going back to that inverse relationship, if ROM, IRXCR, is assessed as high, we have to set DR low. How exactly do we do that? What practical steps lower detection risk?
We manipulate the nature, timing, and extent of our audit procedures.
Okay, break that down. Nature.
Nature refers to the type and quality of procedures. To lower DR, we perform more effective procedures or gather more reliable evidence. For example, instead of just inspecting internal documents, we might seek external confirmation from banks or customers, which is considered more reliable. Or we might use computer-assisted audit techniques, CAS, to test entire populations instead of samples for certain tests.
Better quality evidence. What about timing?
Timing means when we do the procedures. To lower DR, we generally perform more work closer to the year-end date, rather than relying heavily on interim testing done months earlier. This provides more direct evidence about the year-end balances.
So, less reliance on interim work for high-risk areas. And extent.
Extent simply refers to the quantity of testing, usually the sample size. To lower DR, we increase our sample sizes, test more items, examine more transactions.
More is more in this case.
Essentially, yes. More reliable evidence, nature, closer to the key date, timing, and more items tested, extent, all work together to reduce the risk that our procedures will miss a material misstatement.
That clarifies how we manage DR. But I understand DR itself can be broken down further into sampling and non-sampling risk.
That's correct. Detection risk has two components. Sampling risk is the risk that the conclusion we reach based on testing a sample might be different from the conclusion we'd reach if we tested the entire population.
So it's the inherent uncertainty of not looking at everything.
Exactly. You might get unlucky and pick a sample that happens to have fewer errors than the population as a whole, or vice versa. The only way to eliminate sampling risk is to test 100%, which we usually can't do. But we reduce it by using appropriate sampling methods and, crucially, by increasing the sample size. Larger samples are generally more representative.
Okay, that's sampling risk. What's non-sampling risk?
Non-sampling risk is basically the risk of human error by the auditor. It's the risk that we mess up for reasons other than the sample size.
Like what kind of mess-ups?
Oh, various things. Using an inappropriate audit procedure for the risk identified. Misinterpreting the evidence we gather. Failing to recognize an error when we see one. Poor planning. Inadequate supervision. Relying on inexperienced staff for complex tasks. Essentially, any failure in applying audit procedures correctly.
This sounds potentially more dangerous than sampling risk, as it's about competence.
It can be. You can have a huge sample size, but if the auditor doing the work doesn't understand what they're looking at or misses a clear error, the sample size doesn't help. Non-sampling risk is managed through things like proper planning, good training, assigning experienced staff to complex areas, clear instructions, and, very importantly, robust supervision and review of the audit work by more senior team members.
That review process is key to catching those human errors.
Absolutely vital.
Now, we apply this whole risk model, IR, CR, DR, at two different levels, don't we? The financial statement level and the assertion level.
Yes, that's an important distinction. We assess risks at both levels. Financial statement level risks are broad, pervasive risks that could affect many different accounts and assertions across the financials. They often relate to the overall control environment or major business uncertainties.
Can you give examples?
Sure. A classic one is going crabbing. Concern risk doubts about the company's ability to continue operating for the foreseeable future. That impacts evaluation of almost all assets and liabilities. Another is a weak tone at the top, or evidence of management override of controls that undermines the reliability of everything, or maybe operating in a highly volatile industry or facing significant litigation.
And the response to these broad risks has to be equally broad.
Yes. You can't just test one account more. The response is more systemic. It might involve assigning more experienced staff to the whole engagement, increasing the overall level of professional skepticism applied by the entire team, making audit procedures less predictable so management can't anticipate them, or perhaps incorporating more elements of surprise in the timing or selection of tests.
So a general heightening of vigilance. How does that contrast with assertion level risk?
Assertion level risk relates to specific risks tied to individual assertions about particular classes of transactions, account balances, or disclosures. Assertions are the claims management implicitly makes in the financial statements like completeness, existence, accuracy, valuation, cutoff, rights, and obligations.
So this is much more targeted.
Much more. Let's go back to that inventory example where turnover days jumped dramatically. Our risk assessment identified a high risk related specifically to the valuation assertion for the inventory balance. That's an assertion level risk.
And the response is equally targeted.
Precisely. The response wouldn't be to change the whole audit team. It would be to design and perform specific, focused procedures to address the inventory valuation risk. We'd spend more time observing the physical inventory count, focusing on identifying slow-moving or obsolete items. We'd rigorously test the cost versus net realizable value, NRV, for high-risk inventory lines. We'd scrutinize any write-downs made or proposed. It's a surgical response to a specific identified risk.
Okay, so we assess risk broadly at the financial statement level and specifically at the assertion level and tailor our response accordingly. That whole framework, IR, CR, DR, applied at both levels, really forms the engine driving the audit strategy.
It absolutely does. It dictates where we look, how hard we look, and what evidence we need to obtain.
Right. We've planned, understood the client, assessed the risks using the IRX, CRX, DR model at both the financial statement and insertion levels. Now we get to the pointy end of planning. actually deciding what kind of audit approach to take based on those risks. You mentioned earlier this is like a fork in the road.
Exactly. The assessment of control risk, CR, which we do during planning and often confirm with interim testing, is the key determinant here. It dictates our overall strategy for gathering evidence about the account balances and transactions. We're essentially asking, can we place any reliance on the client's internal controls to prevent or detect errors?
Okay, let's take the first path of that fork. What if we assess CR as low? We think the controls are likely effective.
If our initial assessment during planning suggests CR is low, or maybe moderate, and we expect the controls to be operating effectively, then we plan to take what's called a combined approach. This is branch one.
Combined approach, what does that involve?
It means we will perform tests of controls. We need to gather evidence to confirm our initial assessment that the controls are actually working throughout the period we plan to rely on them. This is often done during the interim audit.
And if those tests of controls are successful, if they confirm the controls are working,
If the test provides sufficient evidence that the controls are indeed effective, then the auditor is justified in planning for reduced substantive procedures when it comes to testing the actual account balances and transactions themselves, typically during the final audit.
why reduced?
Because if we have evidence that the client's own system is effectively preventing or detecting errors, we need less evidence from our own direct testing of the balances. We gain some assurance indirectly through the controls. This is usually the more efficient approach.
More efficient, because testing controls is often quicker than testing thousands of individual transactions.
Generally, yes. Testing a control might involve examining evidence that the control operated consistently on, say, 30 or 40 items. Testing the balance substantively might involve checking hundreds or thousands of items directly, so if controls work, it can save significant effort.
Okay, so that's branch one. Low CR expectation, altered test controls. If successful, reduced substantive procedures. What's branch two? What if controls look weak from the start, or our interim tests show they're failing?
Right. If our initial planning suggests CR is high, maybe it's a small company with poor segregation of duties, or management has a history of overriding controls, or if our tests of controls during the interim phase reveal they are not operating effectively, then we cannot rely on them.
So we have to take the other path.
Yes. We must adopt a primarily substantive approach. This is branch two. If we can't rely on the client's internal defenses, we have to assume that misstatements could be flowing through undetected into the financial statements.
And what does a substantive approach mean in practice for the audit team?
It means we need to gather almost all of our audit evidence directly from the account balances and transactions themselves. We will perform full substantive procedures, which usually involves extensive tests of detail.
More detailed testing. Like what?
Much more. More tracing of individual transactions from source documents to the accounts, more vouching from the accounts back to supporting evidence, larger sample sizes for things like receivables confirmations or inventory price testing, more detailed analytical procedures applied directly to the balances. Every decision, from setting materiality lower to selecting larger samples, will be geared towards maximizing our ability to directly detect material misstatements.
So going back to that receivables example, high IR due to the jump in collection days, and maybe high CR because we found weak credit control procedures during interim testing. That pushes us firmly into branch two.
Absolutely. High ROM, IR x CR, means a substantive approach is necessary for receivables. We'd perform extensive tests of detail, confirming a larger sample of balances directly with customers, rigorously analyzing the aged debt listing for recoverability, examining cash received after the year end to see if those debts were actually paid, maybe even reviewing correspondence with overdue debtors. We're getting our hands dirty with the details because we can't trust the system.
That direct link between the risk assessment and the chosen approach is really clear now. But there's a catch, isn't there? Even if we do take the combined approach, branch one, because controls look great, we can't just skip substantive testing altogether, can we?
No, absolutely not. That's a crucial point. The auditing standards are very clear. Some substantive procedures are always required for all material account balances, transaction classes, and disclosures, regardless of the assessed level of control risk.
Why is that? Even if controls seem perfect.
Because of those inherent limitations of internal control we talked about earlier, there's always a risk of management override, collusion, or simple human error within the client system. Controls can reduce the risk of misstatement, but they can never eliminate it entirely. Therefore, the auditor must always obtain at least some direct evidence from substantive procedures.
So even with fantastic controls over payroll, We can't just rely solely on testing those controls.
Correct. We might significantly reduce the extent of our substantive tests on payroll, maybe test a much smaller sample of wage calculations, or rely more heavily on analytical procedures like comparing total payroll cost to budget or headcount numbers. But we still have to do some substantive work to get direct assurance over the payroll expense and related balances themselves. We can never get audit evidence only from tests of controls.
Okay, that caveat is important. So to sum up this response part,
Yeah.
our assessment of control risk dictates whether we test controls hoping to reduce substantive work, combined approach, or go straight for detailed substantive testing, substantive approach. But either way, some substantive testing is unavoidable.
Precisely. And those initial risk assessment procedures we discussed back in Part 2 inquiries, observation inspection, and especially analytical procedures, they're critical for informing that initial CR assessment and identifying the specific assertion level risks that need the substantive focus. If analytical procedures show the gross margin has unexpectedly collapsed, that signals high roam around cost of sales and inventory valuation, pushing us towards needing extensive substantive testing there, regardless of what we thought about controls initially.
It all ties together. The planning and risk assessment phase truly sets the direction, scope, and intensity for the entire audit. It ensures our resources, time, people, expertise are aimed squarely at the areas where material errors are most likely hiding.
That's the definition of an efficient and effective audit. Doing the right work in the right places. Without that solid foundation of planning and risk assessment, the rest of the audit is just, well, potentially wasted effort. Hashtag outro.
So let's quickly recap. Today we've really dug into the foundations of a quality audit. We covered those three crucial pillars. First, the appointment process, the gatekeeping, the ethical checks, making sure the firm is qualified, independent, and competent before even saying yes.
The due diligence.
Second, the detailed planning phase, understanding the entity inside out, its environment, its risks, and using tools like analytical procedures to guide the audit strategy and the detailed plan.
Setting the stage, effectively.
And third, decoding that conceptual framework of audit risk, understanding inherent risk, control risk, and detection risk, and how their interplay dictates the nature, timing, and extent of the work we actually perform.
And remembering that inverse relationship. Higher client risk means the auditor must do more work to keep detection risk low. Mastering that connection is fundamental for professional competence and, frankly, for exam success.
Absolutely. Now, for a final thought to leave you with, we spent a lot of time talking about professional skepticism, the auditor's duty to challenge, to probe, to investigate during planning and risk assessment. This often leads us to identify significant risks or weaknesses in the client's controls,
Which we are professionally obligated to communicate to management and those charged with governance, usually in what's called a management letter.
Right, and that raises an interesting practical point. Think about it from the other side. How does management actually perceive this deep dive the auditor does into their business, identifying all these risks and potential flaws?
Does being transparent about these risks, highlighting control weaknesses, pointing out areas susceptible to misstatement, does that improve the client relationship because you're adding value? Or does it sometimes complicate it, perhaps making management defensive?
And why is finding that balance, being professionally skeptical and communicating findings clearly, yet maintaining a constructive and collaborative relationship? Why is that delicate tightrope walk so essential for actually achieving a high-quality audit outcome rather than just ticking the compliance boxes?
That's the human element, the politics of the audit, if you like, something to definitely mull over as you think about applying these technical concepts in the real world.
Indeed. Well, if you found this deep dive helpful and you're looking for more focused resources to support your ACCA studies or your professional development, remember, there are more SmartPass resources linked in the video description below.
And please do consider subscribing to the SmartPodcast YouTube channel. We share lots more expert insights and study support there to help you break down these complex topics.
Thanks so much for joining us today for this crucial deep dive into audit planning and risk assessment. We hope it helps lay a strong foundation for your understanding. We'll see you next time on The Deep Dive.